Hello, Market Club members everywhere. Well, Draghi drops out of the Jackson Hole. Volume dries to a trickle while traders savor the last days of summer. Adam Hewison here, co-founder of Market Club, with your midday market update for Tuesday, the 28th of August. It's official. European Central Bank head Mario Draghi has called off his trip to the annual Jackson Hole Conference of Central Bankers. It's a nice little soiree for everybody out there. What that means is anyone's guess. His official reason was because of heavy workload foreseen in the next few days. Got it. Just a reminder, we have a very thin trading conditions at the moment on the big board. Many traders are still on vacation. We have a convention, a hurricane, Jackson Hole, and all kinds of other distractions this week. In a nutshell, the markets are moving on very thin volume, which sometimes can cause distortions in the market activity and price action. Keyword this week, caution. Now let's go to the charts and our trade triangles to see what's happening. Okay, let's go to the charts, and to do that, we're going to go to our portfolio, which is right here. I just have to click it. I've got it already set up for us. The S&P 500 plus 100, it's a bull market according to our trade triangles. The Dow, however, is 65. It's a trading range. It's not a bull market. So a little bit of a concern there. But let's take a look at the market itself. Very, very, very quiet activity right now on the marketplace. Now we do have 100 plus 100, so the trend is definitely your friend. You can see we talked about this last week when the market pops out of the channel and then comes back in. So we're back up here towards kind of midpoint, really not much going on. We're getting back into an overbought condition. Nothing dramatic right now, but it's not oversold like it was here, which corresponded to this level here, or overbought like here. So I think for the most part, we're in a trading range, even though it's in a bull market. Certainly the Donchian trade channels are containing this market, at least for the time being. Very, very quiet. It's, lest we forget, it's August, it's summer. There's nothing going on. The convention, the hurricane, you name it, people are not focusing on the market right now, and volume is at a trickle. So let's clear the screen and go to our next market. The next market we're looking at is going to be the Dow. Now the Dow is presenting a little bit of a different picture. And the picture we're seeing on the Dow is really, it's a 65. So the long term is down, the intermediate term is up, giving you that trading range, the 65, and the daily is down. So it's really not a very positive picture for the Dow at all. The other markets look a lot more positive in our opinion. So maybe that's a strategy to be basically long the S&P 500 and be short the Dow and sort of hedge yourself on that. It's kind of like a hedge play. But the same thing could be applied to the NASDAQ, long the NASDAQ, short the Dow on a trade. But we're getting just peeking it into that overbought territory that we've talked about before. And so this is our indicator here. Is what we're using is the Williams percent R indicator. It's an oscillator. So basically what it does, it just goes up and down with prices like this and so forth. And you sort of get the idea. In a trading range type market, it's excellent to use, even in a bull market, because what you're looking for in a bull market, like let's say we have a signal now, is a oversold condition like this. Then you can get in. And conversely, in a bear market, you want an overbought condition so you can get short. It's pretty simple how that works. But this is an oscillator. It's best used in trading range markets as opposed to trending markets. Strong trending markets can go on and on and on, kind of like the little Energizer bunny, if you remember that. So let's just clear the screen. And let's go to our next market. The next market we're going to be looking at is the Eurodollar. Now, the Eurodollar is putting in a pretty good performance right now. But again, we're not so enthusiastic on the upside here. Our long-term monthly trade triangle, let's just scope this out for a little bit. And we have to scope it out quite a bit because if we have to go all the way back to July of last year, right here. That's July 2011, where we had a signal right here. Here's the signal at 139.69. Market's trading at 125, so it's a very, very good signal, very positive. And as you can see, the euro has basically just sort of meandered down, and it really hasn't done anything. I think what's going to happen again is the European mess is not going to be contained. It's going to continue to be an eyesore and a problem for the world banks. And I think we'll have one more push down. And we're still looking for the 1 117 level or the 120 level. That's in the short term. So let's see how that plays out. But generally speaking, I think the euro is getting close to resistance. It's certainly back into a overbought condition on the Williams percent R. And again, this 70 tells you it's a trading range. Still at the top end of the trading range, but still a trading range. So let's just see how that plays out. But generally speaking, nothing to get too excited about. This is pretty much all short covering rally in my opinion, but we'll see how this plays out in the next few days. Mario Draghi, of course, is one of the principal actors in this whole stage. So let's clear the screen and go to our next market. Yeah, the next market we're looking at is crude oil. Now, crude oil, this has got to be, I'll scope this in even closer because I want to share this with you. Crude oil has got to be a major disappointment if you're long. Here you have the hurricane heading towards Louisiana, the whole refinery business down there, and the market's unchanged for the week. I mean, that's pretty pathetic. So I think the key thing here in my mind is we're keying off our long-term trade triangles here, and from 97.89, the market's 96.11 right now, and the 98 level right here, this is a Fibonacci number, and that is likely to contain the market. It has done so far. It's a 61.8%, 61.8% Fibonacci number, which is a very strong resistance area for crude oil. This is the October contract we're looking at. So that's something to really key on. And just to clear the screen for a second, I'll show you exactly where this Fibonacci line is. Let's go out a little bit further. And we did this yesterday, but we keep doing it because we think it's valid. So we measured from the highs right here down to the lows. And it takes you right into that zone, the 98 level, and you can see how that stopped the market. Now, traditionally, the Fibonacci levels, the key Fibonacci levels are as follows. There's a, right here, just to clear this up, it's 38.2. This one is 50%. And the last one here is 61.8%. Now, these are all very important percentage retracements. For example, if a market's going down, it's not unusual for it to have a retracement back. And conversely, if it's going up, it's not unusual for it to have a pullback. And the pullbacks that most traders look at, professional traders look at these levels. And you can see how they sort of stop the market very close to here on the 38, very close to here on the 50, and again on the 50 here again. And then now we're at 61.8%. So it's not to say it can't go higher, but certainly this is an area that warrants some sort of watching. So let's clear the screen and go to our next market. Next market is going to be gold. Gold is in a bull market. I mean, I'm just going to say that out loud. It's in a bull market, and we're expecting this market to go higher. So let's just put it very simple. Gold, bull market. And that's all I have to say. The market's going to find any kind of pullback from here. Even if we pull back to the 1640 area, I still think it's probably a buy. Look for some consolidation, but the market's moved out of a very, very strong energy field. And this is really the first signal. In fact, let's just clear the screen off. We don't get that many signals on our monthlies, and that's why they're so valuable and important to trading. So let's scope this out just a little bit further. And the last buy point we had on our monthly, if I'm not mistaken, was right down here, and this is back on March 1st of 2011. And the market went from this area here, and I can just scope it over. In fact, let me just scope it over. It'll tell you the exact price on March 1st. At $1,430, it went all the way up to $1,900. So that's how important these monthlies are. That's the last signal we had. So very important. The market's currently trading at $1,668. The signal was at $1,670. So you can buy it actually a couple of dollars lower. Not an unusual thing, because you can see right back here, the market actually came back down after original signal. So it's an opportunity, I think, any kind of pullback in this market to be a buyer. So let's go on. We're going to look at copper. And copper is really kind of like the traders just taking money out of each other's pockets here. It's lower for the week. Not a lot of excitement. Is it still in the trading range? 55. You've got the mixture of the monthly down, the weekly up, which is giving you this cross between no trend. The 55, it's trading range. I think the 355 level, 350, 355 level is going to offer resistance, and the 335 to 340 area is going to offer support. That's pretty much all you can say. The one thing to look at, perhaps, is to look at the Williams percent hour, which does very, very well in trading situations like this. And what you're looking at there is, I'm just going to draw this in, and you see how that line goes down like that, and the line goes up like this. Well, that's a divergence. Now, this is a negative divergence. And what that means is the prices went higher, but the momentum did not go higher, which indicates that you're going to see a pullback. And we're seeing a little bit of a pullback, not much right now, but we're not yet in an oversold condition. We're getting there, but we're not yet there. So let's just clear the screen off, go to our next market. Little enthusiasm for copper. And this is silver. Silver, of course, had a huge move up these, 1, 2, 3, 4, 5, 6, 7 days in a row. Very, very difficult for a market to make it 8 days in a row. Of course, we had the down day yesterday, and we've seen a little bit of a recovery today. Not yet in a bull market like gold. So here's the number one thing, the 29.98 level. Very close to where we are right now. Still saying the market's in a longer-term downtrend. We need to be convinced, and I want to be a bull on silver if and when we get this signal, okay? Intermediate-term traders should be long this market, of course, with our weeklies, and that's how we recommend trading a commodity, which this is. It is a commodity. So, again, pay close attention to that. So, Reuters Jeffrey CRB index, this is our inflationary index watch. And again, looking at this, you can see that we're at the top end of the Donchian trade channel. We were oversold right here, indicating that we think the support's coming between 305 and 300 on this index. Longer term, I'm just going to put a line chart in here. And I'm going to scope, let's just make this very simple. I think this could be one of the keys for the markets, both equity markets and commodity markets, in determining if inflation is going to be a big, big problem. So let's just go out a couple of years and see what this is happening. So here's the big picture. This is actually this maximum picture. We basically, I'm taking off the monthly. So you'll see the highs were right here. This is on July 2nd, 2008. That's when crude oil was around $140 a barrel. And if we simply draw a trend line starting from here and drag that down, so we are still below the trend line. I would prefer to get another line point in there. We may get it this time around the 320 level. Let's see what happens. But generally speaking, this market is, I think, poised to go quite a bit higher. So let's see how that plays out. But it's, as I said, the volume is very, very quiet. And what you may want to do in a situation like this is, give us a call. We've got our consultants are standing by to help you. It's a free call. It's a free consultation. 877-219-1482. And let our personal one-on-one Market Club coaching help you become a winner in the fourth quarter. Hey, I'm Adam Hewison. I'll be back tomorrow. We're going to do a TV show, a full 1 hour show. Hope you can join us at 1 o'clock tomorrow. I'll see you then.